to offset. Yeah, it's really good to offset, high wage W-2 earnings. It can also be used to offset capital gains. We've got, it's kind of what I would call even like a little bit of a hybrid, where it's got the dollar for dollar tax deduction on your tax return. So the minimum that we work with is $25,000. So you're going to end up having a $25,000 tax deduction followed by the cash flow. They'll start cash flowing in the second quarter of next year, and then usually they'll start paying out quarterly. The averaging about 10 to 13% in the 7th month, and then every quarter after that, it will start, paying out some more. And then the idea is, I think even with the current inventory, and Fred can probably go to better in depth on this, but I think even the current inventory, you're returning your investment in about 3 to 4 years, compared to normally it would take much longer than that. But I could probably even let Fred kind of give some more information on that at the moment.
Sure. So do you have the document? I think the document that you had sent me earlier on to share, I wanted to make sure that everyone on here does understand the benefits of doing an oil and gas. First of all, it's an investment, it's an alternative investment. So it's not like real estate. The tax benefit of investing in it is that you're able to get an upfront deduction for the depreciation. That's one of the tax benefits. But in addition, you also get a regular ROI for investing in oil and gas. So what we're looking at, for those of us that are looking for strategies and things that we need to implement before year end, we're saying that oil and gas could get you there. So the two things that you first of all need to do is, did you have enough money set aside to do any kind of alternative vehicle? I know most of us are in the real estate space. So beyond the real estate space, are you looking for kind of like an alternative investment vehicle? 2, do you need that upfront tax deduction to lower your tax liability? So if the answer is yes to those 2, then the discussion about the oil and gas would kind of help. Ryan, do you have the documents that you had shared before that we can look at before Fred comes on?
Yep. Hey, Fred, did you happen to have that up, or do you want me to bring that up? I don't know.
Yeah, I've got something in front of me from a visuals perspective, Ryan. I'm not sure what was sent before. I can pull up what you already have, or I can just share a screen to kind of walk through some of the concepts, if that's even better.
Yeah, that's fine. Yeah, that'll work.
Let me see. Now, Ryan, if I do that, does the screen change for you guys?
Yep, I see it.
Yeah.
Okay. All right. Well, we don't need to hit everything here, but I think this will kind of lay out a little bit of the pertinent information, and we can kind of pause as it makes sense on the certain topics in concepts. But I'm just gonna guess initially, Ryan, what was sent was probably the one pager, like the highlights piece with the tax handbook. Is that kind of a starting point?
Yeah, and I think I think I even sent like the tax handbook, I think, for the drilling funds is what I had sent over, and then maybe even the one page for the RIA strategies and all that.
Okay, yeah. So we can reference that. I've got that in front of me as well. The tax handbook is great because it cites all of the tax code. It points out to what I'm about to go through and where to find it within the code. It's really not about us, which I'll kind of talk about offline. But it is a nice way to see, okay, how are the K1s laid out, and from a filing perspective, how does it work? The biggest thing that I'd say is that it first starts with the company that's doing it. So we're a 40-year-old oil and gas investment firm. We've been doing this a long time. And it's been an interesting couple of years where in the last 2 years, everything we've done has actually been run and managed by the majors. We haven't haven't fortunately, unfortunately touched our own inventory. We've been able to access some of the best acreage that's out there doesn't happen to be our own. So basically what this means is that we're operating, or our fund is being operated by XTO, which is the drilling division of Exxon, Chevron, Shell, Oxy. 90% of the funds that we do are located in the core of the Permian Basin and operated by the majors. So that's been a pretty unique thing, and I'll talk about the investment side and what that means. But for anyone that's interested in us, in our history, you'll find a lot of information about us out there on a number of different third-party sites or our website. You'll see a lot of activity. Our activity in the last couple of years has really been honed into what's been, and this is basically a heat map of the core of the Permian. So when we look at where are the assets in our fund located, we can kind of get through the geology there. We'll talk a little bit about the performance side of things, but let me kind of come back to this for a second. And I want to hit what people are really interested. The one reason people think of oil and gas when it comes to tax planning is that there's a lot of unique characteristics within the tax code where you can write off, and it depends on structure, but this year it's up to, in certain situations, up to 99%, typically between 93 and 99% of their investment that's put in, they can take as an above the line deduction against any kind of income. So your actual savings are going to be your highest exposed federal brackets plus any SALT tax. But that's just part one, right? That's what they're putting back in their pocket when they upon entry as an above the line deduction, right? So on a dollar, that's 5 to 50 cents. But yes, go ahead.
Yeah, is this Fred?
Yeah,
This is yeah.
Okay, hi Fred. Yeah, so just to make sure, if we invested $25,000, then the client can expect to save their effective federal and state tax rate. So if it's 20% federal, 7% state is a 27% deduction. If it's 15% federal, 4% state, it's 20%. So it's based on their effective tax rate in terms of what they'll see as a saving. So it's a deduction, not a credit, right?
Correct. It's not a credit. It is a deduction. Exactly. Yeah.
Okay.
Yeah, and normally it's really and it depends on your brackets too, right? For the client that has $1 million, I'm just using an example, but $1 million income that puts 100,000 into this style of a vehicle, that last 100,000 between 900K and $1 million, that's getting hit at 50%, right? You're getting that last dollar, how that was being taxed otherwise. But I mean, you can look at it either way, but the reality is because it comes off the top, it will help chew up those highest tax dollars first, which are typically to the right of that spectrum of the progression of the tables.
All right, I know that Regina is on. Regina, thank you for joining us. I appreciate this. Based on what you've heard so far, from an investor standpoint, is there any other thing you think clients need to be aware of before we move on in terms of the tax benefits?
Well, I joined 3 oil and gas investments over time. And I used them basically as the gentleman was indicating, although I came on late, I'm sorry. I didn't have the Zoom set up properly, to offset income. So I don't know if he got into the 2 different types of deductions you could take from an oil and gas investment. But I did use both pieces of that and offset income. I will say up front that the particular investments that I worked in did not provide much in the way of actual income, although I managed to take tax deductions at my rate, which means that, of course, was not everything. I was able to deduct round figures. Say you invest 100,000, you're able to deduct like 80% of that for your initial deduction for the ICE investments, and then 20% for your tangible deductions over the next X 5 years, whatever it was. So I was able to use those as tax deductions. That doesn't mean I got back all my money. I got back whatever my tax rate was, 25% or whatever. It became a deduction in my taxes, with the potential that I was supposed to be getting more income over time. So it was a way of investing in order to gain income over time. The three different projects and types that I was involved in, only one of them was moderately successful, and the success was when we sold out and I was able to get some return, capital gain return, not much. But usually you go into this with the expectation that the wells are going to produce for years and years, and you get some return. So that's where I'm starting from, and we can go into more of that when you start your discussions.
Yeah, I'll actually, that's a nice tie into there, and I'll kind of back up and go through to what that looks like. So, yeah, in outside of that first year, that investment year, in this case is 2021, that's really about the tax planning, the whatever you're getting from a deduction perspective in that first year. Starting in the second year, and this will be next week, right, for 2022, you look at the cash flow side of things. So normally it's taken us, I've been here 8 years. It's always been between, October and November when the first distributions get out. That started to come down. We started to see a quicker turnaround to cash flow last year, where it was back in June, when the first distributions were paid out for the 2020 fund. This year, because we got started much earlier, we're going to have substantial cash flow in the first quarter. So we'll close this fund next week. We'll have Q1 income. To give you an idea on the cash flow side of things, I'll show you the last couple of funds and how they're doing. But basically, and we're seeing, obviously, the first few years are higher than the rest, right? Back to your point, where you should, if it's done well, it's designed well, and it's managed properly from a risk perspective, you should see predictable, substantial cash flow in the first several years that will deplete down by design over time. So what does all that mean? We're looking at 30 to 40% cash flow in the first 12 months. Our 2020 fund's first distribution was smaller, about 2% in the second quarter. It was about 10% in the third quarter. It's tracking for about 12 to 14% for the fourth quarter. 2019, same thing. Similar numbers, within 1% or 2% of those. But this is not tax benefits. This is straight cash on cash flow that the assets in the fund themselves are generating, right? So you really want to look at something that can ideally give you your principal back within the first 3.5 to 4 years. Not talking tax benefits, just cash on cash. That should be a reasonable expectation in the current market. If you're going to put $1 into these style of funds, is how long via cash flow does it take to get your initial dollar back? And we're tracking for between 3.5 and 4 years for this current portfolio. So that's separate from tax benefits, and doesn't mean they stop cash flowing. They'll cash flow for years and years, but your first 1x or your first recovery of investment should happen in that 3 to 4 year period of time.
How long has it typically taken to cash out?
Yeah, it's a really good point. So the life of a well, if you read a prospectus, will tell you 25 years. However, you're really closer to 10 years because, one, even though they'll cash flow for decades, the bulk, it's that champagne bottle effect, right? When you open it and a lot of volume comes out quickly, and then it's similar for the style of assets that we operate. You're looking at flush production for the first several years, but it does decline down. So a short answer, I would say about 10 years is a reasonable expectation of being in the fund. Not that it will shut off at that point, but the cash flow that we're seeing at 40% a year right now is probably going to be 2 or 3% a year in year 10 because you're seeing a depletive asset and those declines that will naturally kick in over time.
Okay.
And I didn't know if you were going to touch on this about like the difference between, I guess, how we use, since we work with an RIA, how that kind of saves the client some syndication costs, the commission costs.
Yeah.
So kind of raises their overall net with
The write-off.
the write-off in terms of the deduction being much higher than 80%, then also that the net just overall is going to be much higher. I don't know if you could speak to that or not a little
Yeah,
bit.
in that structure, your write-offs. So yeah, and you were right, Miss, at the beginning. Those IDCs, intangible drilling costs, that is a substantial part of a well-designed fund in the first year to maximize your tax benefits. The highest level by law is typically 92%. However, in the RIA structure, with what Ryan does, because of the cost savings to the clients, your actual effective write-offs are 95 to up to 98% sometimes, because you're coming in at a discount. You're getting some of those front end fees are stripped out because of that structure. So it basically provides a discount to clients, so it increases the amount that they can have from a deduction perspective.
Okay, can you unshare your screen for a little bit? Let's start addressing some questions. So guys, based on
Sure.
what you've heard so far, do you have any questions for Regina, for myself, or for Fred or Ryan while we before we move on to the logistics?
Yeah, I have a question. This is Eric. So it sounds like from what I've heard thus far, there is some variability in the cash flow that's received every quarter. So it's not consistent every quarter. Basically, it would vary based upon, I guess, how much oil is produced every quarter.
Yes, sir,
am I
that's correct. It will. Yes, sir, you are. It will have. It's not a preset distribution. It pays out as it earns, and as it distributes. Yes.
And is there a requirement for the money to be invested? So is there a term requirement? In other words, if I decide to invest, do I have to, is there a certain amount of time that I have to keep the money invested?
No, I mean, I guess short answer, about 2.5 to 3 years is the short answer to your question. Because now, and that's just because of the way the presentment feature, which is if someone wants to get out early, is designed. It's highly illiquid. It's not recommended. And really, these are going to be much better performer if you hold them to term. But yeah, at least the first couple of years that you'd have to, because it's just not available before that.
Okay.
So my question was similar to that with the exit strategy. Is there, if you decide to get out within like the 3 years, I already good, I've gotten enough to make back my initial investment, I want to invest those funds in something else now. Is there a fee to withdraw those funds, or is it just discouraged?
Well, it's, the first couple of years you can't. There's no way to tender those back to our firm for the first 2.5 to 3 years. It's just not possible.
Because
if you were to
like
sell it
private
before,
investment, right? It's like selling your interest in a partnership. You would have to sell it to somebody else that you know, not necessarily giving it back.
And once you receive the cash
Correct.
flow, it's free for you to do whatever you want to with it, much like a paycheck or whatever. Once you receive it, you're good to use that money.
And Ryan makes a great point, because the liquidity of these assets are a bit unnatural to what most people are used to, right? Where you bought a stock for $1 and you're going to hold on to it till it turns into 2 or 3, and or they decide to get out if it's not working. Here, the money is highly liquid. It is tied up. It is invested fully in the assets. There's no cash kept in the fund for redemption purposes, right? So it's highly illiquid in that regard as a private security. However, back on from the investment perspective, just using $1, if someone's saving 30 cents, 40 cents, 50 cents in a blue state upfront from tax benefits, let's fast forward 12 months. You put invest $1 in, you've got the immediate recapture of even 30, 40%. We're also seeing 30 to 40% cash flow within the first 12 months. So within 1 year being in the fund, you've got 60 to 80% cash on cash back in your pocket already. Fast forward another year, you've got another 25 or 30% cash on back. So within 2 years, you're looking at dollar in, dollar out in that period of time, with still years and years and years of cash flow. So the liquidity of these comes really through the cash flow and the tax benefits that they generate.
Got it. Thank you.
When do you get your principal or initial investment back? Do you ever get it, or that is just dissolved and the cash flow is what you're making at that point?
Yeah, it all comes back via cash flow. So short answer to your question, about 3.5 to 4 years of cash flow. So if someone put up 100,000 in, they would get 100,000 out in cash flow in the first 3 to 4 years.
And
So
how
really,
many?
so what you're saying is that after 4 years, whatever you get back after that point, over and above the 100,000 is really your return. So technically, you're not getting your capital back. You're getting tax benefits plus ROI, which should exceed your 100% investments in the first 10 years.
Yeah, that's 100. That's exactly right. Let me say it this way too. These are mediocre ROI investments, and here's what I mean by that. Over the 10-year life of the fund, cash on cash, we're looking for 1.5 to 2x, $1.50 to $2 on every dollar invested. That's the ultimate cash on cash over the life of the fund, because there's not enough embedded risk in the style of assets we operate to do that much better than that. However, they're phenomenal IRR tools. The internal rates of return, time value of money, are anywhere between 15 to well over 20%, depending on your brackets. And it's because of that pace of capital, right? So we think of a stock that you bought or an equity for $1 and you held it for, 7 or 8 years and it doubled to $2. That's great. You got to win because $1 turned into $2. Well, here, these are worth less than $1 later. But again, you're looking at 30 to 40% cash flow freed up day one from tax savings, another 30, 40% from the cash flow it's earning, and then it continues from there. So you have a lot of very front-loaded, heavy cash flows attached to these assets. That is just real-time cash flow to hopefully buy other assets and grow those. So they're really good cash flow tools, but they're not huge. Okay, I put in $1 and I sold it for $10. That's not what we do, right? They can be really good from a tax saving and cash flow standpoint, but they're not designed to grow in value. They, by design, will deplete in value.
But the cash flows are contingent on the actual wells producing, right? So
Sure.
the
Yeah,
cash flow
absolutely.
isn't guaranteed. It's contingent upon how, whether or not the oil and drilling of the wells is actually producing.
That is correct. Yeah, it's not guaranteed. It is security. Absolutely. 100%. It is. However, when in our style of these assets, we do only what's called proven developed production. You're not going into new undeveloped areas or exploratory drilling, anything like that. You're not going into these unknown areas. We don't worry about dry holes or non-performers, because you're going into proven developed production. So you get a lot of predictable cash flow, and we have a lot of hedging strategies embedded to the fund for downside protection, so that we don't have to always worry, well, what if oil goes back and crashes? We've already figured that out because of the hedging structures that we've built into this. So yes, there is dependent. Is one well going to produce 2,000 barrels a day and one well might produce 1,800? Absolutely. That's going to happen all over the place. But the reality is, for the style of assets, and it's the most conservative of the oil and gas industry that we do, we have a lot of predictability, which is why we're seeing the cash flows that we're seeing in this current market.
I don't have your name, the gentleman who's been talking.
It's Fred.
Fred, hi. This is Regina. I did read the material that Ryan sent me. I did not include the PPM or any of that level of detail. It was more the highlights and the summary of the investment. In that material, it indicates that you can cash in your units once each year, beginning in 2026, assuming they don't get more than 10% of units wanting to be cashed in and them having enough cash flow to be able to handle that. So that's, I guess, a 4 or 5 year investment where you can't cash out. Am I reading that correctly?
Yeah, it's there's 2 different dates that attach to it, right? So I can get you something simplified that would lay this out, but the way it basically works is, yeah, there's that date. Not to get overly technical, but it is the way the prospectus was written. Technically, 30 months after 75% of the entire assets in the portfolio are up and running, which could take anywhere between 12 and 18 months for that first piece to happen. You also have the ability to activate what's known as the presentment feature, which is the same thing we're talking about. So there's 2 dates to that, but Miss, I do have something that will lay all this out more cleanly, so it's more transparent. But yeah, I mean, it's definitely the first 3 years or so up to 4. But I have something that I can get in your hands that'll make it a little bit cleaner.
Yeah, but that was a very fixed date. You can't cash out before January 1st, 2026. Just
Right, which is 4 years, right? So yeah, it's usually 3, sometimes up to 4 years. But yeah, that is a very normal occurrence for these assets.
Yeah, I wasn't arguing it. It was just part of the conversation that we were having. What I probably missed by coming in late was, are we talking about investment in a fund that has multiple wells of all kinds going on, of which you need 75% working before you have all that cash flow and stuff coming in? Or is this a group of wells, 1, 3, 5, 10, 20, specifically numbered wells that are part of this partnership?
Yeah, so the fund itself is going to be a collection of 12 to 15 net wells inside of one single fund, and 25 to 30 gross wells as well that the fund will own. So one well might be $7 million, one could be 10. They're in that range as far as the size and scope of assets that we manage. But it'll be a diversified portfolio of that number of wells in one single fund. That will be well, technically we already have the first 2 assets online in that fund, but you're going to see the remainder built out through the first and second quarter of 2022.
So your diversification is about 20 wells, 12 to 15 net, and I've missed the number of growth.
25 to 30, exactly. Yeah, you're in that ballpark. Yep.
And they will have to be started by March. I think it's March 15, whatever the tax law says.
March, yeah, you have to spud the wells by March 31st to protect the IDCs. But yeah, that's never an issue. As long as you know what you're doing, that's never an issue.
Yeah, just saying what's going on so people are aware of what the diversification is and what the wells are. And so these 20-ish wells are where you're getting your cash flow once they start to produce, after they are drilled and
correct.
Such. Yeah. I will say in the investments that I've had previously, a number of them have had to be capped because of, as you know, prices are such that trying to take oil out of the well is more expensive than they could sell it for. So they've capped a number of wells. I got the impression there were 2 types of caps, and they may be able to reactivate some once prices get better, but some have been actually just closed on me. So I don't get.
Yeah, it depends. If they did a temporary shut-in, you can reactivate that. If they went a P&A route, plug and abandon, that's a little bit more permanent. But yeah, those are a number of ways that could have played out.
Right. So I don't get cash flow from them was my bottom line with that. So 15 to 20 wells plus is probably better than the fewer that I was involved in, because it gives you more options that some could stay active.
That's a good point. It's diversification. Here's the other part, that, and even though we're the largest syndicator of these offerings in the nation, but this has only been available to us for the last couple of years. We have been actively hedging so basically what you're referring to is if prices go the break-even point of an asset, operators are shut in those wells, right? If their break-even is 40 and oil goes to 36, they're going to say, well, we don't make any money. They shut it in, and then everybody just gets no cash flow. Well, and that is a normal, I guess, risk set for our industry. However, when we started this back in 2019, we've actually been hedging out the first 40% of our production. And basically what this does is it gives us some assurance of the first payout, the first 1x or the return of principal within the fund, while keeping the remaining 60% what they call floating, or that is exposed to current price. So it does two things. One thing good and one thing maybe not so good. What it does from the standpoint of good is the safety. It gives us more security around the initial investment. However, you were giving something up for that, right? Because if right now we're hedged in the low to mid 60s, well, what if prices go to 100 and stay there? I'm hedged in the 60s, right? So I'm going to miss out on some of that. But, and I'm telling you this because just to give you an idea for our DNA, what our investor base really demands is, yes, they love tax benefits, but they also want security on the investment before they want big returns.
Yeah.
So we give up a little bit of upside, right? Or maybe a lot. If oil goes to 200, we'll leave a lot on the table, but we still get some participation with the upside, but we also get some downside protection.
No, that's not bad at all, given markets as they are.
One of my questions is, I'm just trying to run my numbers here. So if, let's say I did $10,000, and so I did 4,000 first year, 2,000 second, 1,000, 1,500, 1,500. So at the end of 5 years, I get my $10,000 back, of which 4,000 of that came from taxes. I still need to recover that 4,000 in order for me to really see that this was a true tax benefit. So that means that the question is, am I able to recover 140% over 10 years for it to really be that it was worth the first year tax savings, taking that from Uncle Sam? Regina, do you see what I'm saying?
I understand. That was what I said when I started. I was able to take the tax deductions based on my particular tax bracket for the monies that I put in, and I got tax deductions for that money, which basically meant that that money was working for me, but it was free. But the taxes were taken out already. But the cash flow on my investments never made up, so that I got back the amount of money that I put in. I only got the tax deductions for that, which was a benefit in that year because it reduced my taxes from my other income. So there was that for my 25 or 30%, whatever the bracket was at the time. So it offset income that year. I was able to do something else with the income that was offset, like do a Roth conversion or whatever you might want to use those funds for, or a high tax year, a high income year. I could reduce my taxes by using an oil and gas investment. But that's taxes for the year. That's not cash flow income to me over time, which is what the reason for the investment potentially would have been long term. So I'm not complaining about the investment because I got my tax benefit from it, but I'm not, and the little income I got in, I had the 15% depreciation when there was income coming in, but the amount of income that I got did not equal the amount that I put in. So I wasn't 100% mix. Do you understand where I'm coming from?
Yeah, so that means that for anybody who wants to consider the strategy, which, you know, that's something that's doable. I've done it with a couple of clients. I do it on mine, is that if we're going to invest in this oil and gas, we need to make sure that whatever the tax savings that we have in those first 2-3 years is also reinvested in another vehicle in such a way that when you get to year 10, maybe you got back 100%, in year 10, or you got back 90%. But the tax savings that you got in the first year could also be invested in such a way that by year 12 or year 14 or year 11, that return on investment has also grown to be able to recover that principal differential. So just to give an example, so let's say we invest $10,000 and at year 10, we're only getting back $8,000, and it's likely that we're not going to get $2,000 back. So yes, we invested 10,000, but we got 8,000. So it looks as if we lost 2,000. However, the money that we took from Uncle Sam in the first year, which is the $4,000 that we took from Uncle Sam, if we invest that $4,000 properly, it very well could give us the 2,000 that we need plus some at the end of year 10 when we're done with this oil and gas. So it's to make sure that you understand what the strategy is. One, it gives you tax benefit. You're taking money from money that you would have paid to Uncle Sam. You're not paying it to Uncle Sam. You're using it to invest. However, that money that you're saving from Uncle Sam, that money does need to be invested in another vehicle, kind of like your own personal hedge against not knowing whether we're going to recover 100% of this investment or not.
I will say on the positive side that while the specific investment in one case that I made that basically was getting capped out, so I wasn't getting much cash flow, even though I did get all the tax benefits that we've discussed, both the 80% ICE, and I got back the tangible credits as well over the, what was it, a 5-year depreciation period. Someone who invested in that same company in the next offering that they had, this was a company that was doing 3 wells to 5 wells in each offering. And then they're still getting cash flow from those wells. So it does depend on the wells, the location, the number of wells that are in the investment that allow you to get the cash flow. So they're actually making money. I never personally was able to make money from this particular investment, but I still think the investment was good. There was a question that just came by from Lynn, I think it is, who asked what the minimum investment on this is.
I think
Ryan?
it's 25K, isn't it, Ryan?
Yeah, it's 25K. Yep.
Then the other question that I had was, Fred said something about proven and developed, and then also the hedging. Regina, when you invested, was it in a proven and developed well?
The wells that were all drilled as part of the investment. So they weren't wells that were already producing when my group bought in, so to speak. They were drilling the wells. Now they had the oil and gas X-rays, down, and so they chose wells that they thought would work, they were in areas like Permian and others that have had successful wells right next door to the property and such. They knew where they were heading to get to oil in order for it to be produced. But I don't know if that's the same as what Fred meant when he said those words. If the fund is going into wells that are already drilled and producing, or if part of this is for
they're all new assets. The PDP, so proven developed production. If we were to simplify this, if we were to look at this in the terms of risk and return, right? The most predictable conservative style of drilling that exists is what's known as proven developed production. And all that means is when you go into the actual field sites before the drill bit, before the work is done, the assets that are north and south of you and east and west of you've already seen those assets, how they've performed, right? We've already seen how that other asset right next to you, the neighboring asset, the production rates and all of the surprises. When you get out, then you have something called PUDs, proven undeveloped. You have step out wells, and finally you have wildcatting, exploratory drilling, where 99% of the time you lose everything, but if one well hits, you get crazy amounts of money. That we don't. All we do is on the left side of that graph, if you will, because it's the most predictable. It has the least amount of surprises, and really what, from our perspective, tightens up a pretty predictable cash flow stream so that investors aren't wondering, okay, well, that well was dry, or that well's not cash flowing anymore. So we're giving up two things, right? We're giving up the surprises in some of that, but we're also giving up the ability to turn $1 of an investment into $20 of cash flow, because the risk profile for these style of assets just isn't there.
Okay, so we have some questions in the chat as we get ready to wrap up. How can we obtain a copy of the prospectus? Ryan, how do you want to handle? Do you want to put your email and then have people reach out? Because we actually close in 2 days.
That's fine.
Then can this strategy be used to offset self-employment income? No, it can't offset self-employment income, but it offsets taxable income. The prospectus and private person should be provided. Yeah, so if you are interested in moving forward, yes, you definitely want to reach out to Ryan and then to have him help you, because this needs to be done before the end of the year if you're going to take advantage of it.
Correct.
If you want to invest in it through your solo, yes, you absolutely can. You just won't be getting the tax benefits, because now whatever it is that you're getting, that depreciation, that intangible drilling cost and all that, which is the whole reason for investing, you're not going to get because it's in the solo K. But you should make sure that you're doing the analysis just for the cash flow, because the main tax benefit will not be there for you. That 40% upfront, you're not going to get if you're doing it through your retirement account.
Correct. And just to clarify one thing, within the tax workbook, you can find this does work with self-employment income. It actually works with any kind of income.
Is it a Schedule C, or is it a K1 line 14?
It's a K1 line 13J.
Okay.
But I can send you a copy of the K1 over to Ryan to reference. But what's cool is that it reduces self-employment income, but it's not subject to the self-employment tax. So when the cash flow on these kick in, you don't pay self-employment tax, you don't pay the net investment tax, the 3.8 or the 0.9 surcharge. But there's a lot of things that it's, in addition to depletion allowances, which is 15% tax-free, there are some tax advantages on the way out as well, which we can send you something that will summarize that.
All right, so just to repeat what you said, because this might be important information for those that have a high self-employment tax. You're saying that it will reduce their 15.3% self-employment tax. However,
correct,
the rest of the income is not subject to self-employment tax. So I'm interested in getting that because that means that we're going to be looking more than just the regular federal and state tax.
Yeah,
Mhm.
exactly. You
Addition is-
reduce it again on the way in, but you don't pay it on the way out. But I've got a piece that I'll outline some of that.
Okay, because 13J is an other deduction. I thought it's 14. The fourth line 14. If it comes against my line 14, then that's when I can expect it to help on the self-employment side.
Yeah, well, okay, yes, I'm sorry. The IDCs show up in two places, 13J and 14A,
Yeah. and there's a-
on the
negative-
first year K1.
Yep.
Okay, yeah, if you can, Ryan, if you can get that across to me, because I think that would be very important. So then we're not just looking at 40%. For some people, it could be 50 or 55.
Absolutely. Yep. Yep. I've got some stuff that's also included in the, like the tax handbook, but I can also I can get that over to you and even highlight the lines on the K1 for the
Okay.
13. Yep. Just to kind of give you, and that's the one thing I like about the tax handbook, that it even shows the tax forms, the numbers on there, and kind of gives the examples of how it will look and everything too, just to give everyone, not just yourself, but also the clients and stuff, the information of what everything will look like and where the numbers go and the line items and all that.
Okay. All right, guys, any other questions as we get ready to wrap up? Is anybody thinking of moving forward with this? We're closed on Wednesday. I'm gonna be bye-bye and Merry Christmas. So you only have me today, and then after that, you have to deal with Ryan. So
Yeah, I'm going to be around.
Yeah.
Yep.
does anybody have any other questions, anything we need to address? Because
Yeah.
my name.
So this is
Do you have
Candy.
any-
I'm confident I'm gonna move forward. I just don't, I know we said we were gonna get around to talking through logistics, and I'm not sure that if we did or not, but that's really what I need to understand better. The logistics, whether or not, this will be a contribution directly from my husband and I, whether or not, so just the logistics around it is what I need to understand. And then I should be ready to move forward.
Okay.
I'm sorry, I had cut out. So did they say, how is the cash flow taxed? Is that taxed as ordinary income?
Yeah, so that's
Yeah,
one
there's
of the
a few
things that
components
he
to it.
just- Yeah, that's one of the things you just shared, Nate, that the upfront deduction reduces self-employment tax. And then the subsequent return on investment does not, it's just regular income. I think that would be would it be royalties?
No, it's technically called working interest. So there's several layers to this. The tax handbook has all this spelled out, which
Okay.
we'll send to you. But baseline is the simplest way to think of it. The first 15 to 20% is tax free for life due to depletion allowance. That's the first item. You have a piece that's when we convert general partners to limited partners in the second year, you'll typically see that processed as passive. And so when that happens, the working interest rules kick in as well, meaning that the income is not hit at those other components, self-employment, the net investment, and the 0.9 surcharge. But the best thing to look at is that workbook, which we'll get over, that will spell all of this out a little bit more cleanly.
Okay. So just to do a head count, I have Layla, Jules, Nate, Joy, Agnes Asura, Bridget Osborne, Eric Johnson, Laurie Mahler, Flora Tien, Fred. Is that Yarborough? Fred, oh, sorry. Fred is the one that's presented. Haha, Candy Hall, Lynn Money. So those are the people that I'm gonna send the prospectus and the tax information to, as well as copy Ryan on it in case you need to do something while we're gone.
And Regina.
Flo, in
Can we
terms
get a
of
copy
the
of the
slide,
slides?
yes, he's gonna send, well, this is the same document I had forwarded you, Nate, but I'll get the documents that we just covered here. When I get the tax book, I'll put everything together and then send that to you guys.
Yeah, if you get a copy of the prospectus, I'd also like to see it Barry.
Okay,
Yeah.
so I'll add you
Same
on.
here, Mayor.
Okay.
That's,
And the investment has to be made prior to December 31st.
If you want the 2021 tax deduction, Ryan,
Okay.
is there a hard deadline on that, or would it just roll into 2022?
I think hey Fred, are you guys accepting all the way up to December 31st, or is there a hard date that you guys like the 30th or 29th? Because I think it's just a matter of just wiring the money to have it activated in that regard. Is that correct, Fred? On top of the application.
I think we lost Fred.
Yeah, no, I was just, yes, that's correct. 31st is the final day that we can accept things. Anything that happens in this year, we can process towards this year. Yeah.
When you say accept, what do you mean? The application or the wire? Can you walk us, because we only have 11 days to go. Can you walk us through the timeline? Somebody says, I'm ready to move forward. What are the important timelines that they need to meet between now and the 31st?
Two things. They're going to want to get with Ryan for the application. It's 4 or 5 pages, and then decide on funding. We can take a check or wire, whatever you want to do. No matter what, we want to make sure that everything is sent to us before the 31st.
Mhm.
So if I get this every year, every year, like January 5th comes around and I get like a couple of $1 million sent in because people do it after the first, we have to send it back. So even though it's the holidays, take the next couple of days to seriously think this through and maybe even knock this out before Friday, once everybody's in holiday mode and they go out of pocket for a week or whatever, just so you're not in that position.
So when you say wire transfer, we're fine, because once you do it, you get it within the next day. But if somebody sends you a post-dated check, is it when it gets to you or when it's in the mail, or, how does the check?
If it's technically, if it's postmarked by December 31st and I receive it January 2nd, they can defend that, they will accept that. But if I receive something like a week into January, then no. So technically, if you want to send a check on the very last second, get it in the mail on the 31st and have it postmarked and tracked, and we can work with that. But we recommend strongly to get everything done a couple days before that, so we're not trying to chase those things down and people are worried about it.
Remember, mail is slow.
Oh, yeah.
Yeah, that's the other thing too, so.
And unpredictable.
Does this require you to be an accredited investor?
Yes, it does. This isn't a private placement, and as such, there are accreditation standards for it, where you have to have either a net worth of $1 million or income that is 300,000 married, 200,000 single, as far as an accreditation standard.
So 200 single, 300 married, filing jointly, or $1 million
Yep.
in assets.
Correct. Either or scenario. That is correct.
And what if a partnership wants to come in? Does one person need to be accredited?
Yeah. In that case, like for example, a trust, if the trustees are accredited, that works. But yeah, I mean, it gets a little bit complicated because then you have the trust rules that kick in at 5 million. I've got something that I can send you that has all of the scenarios possible played out. That might be easier.
Okay, not trust. I'm thinking about if people want to come in as an LLC. So let's say it's an LLC that's investing.
Then the member, then whoever owns the member units of the LLC individually will have to be accredited. So if there's 3-member unit LLC, or if it's single member, the ultimate owner of the LLCs would need to be accredited.
Okay.
Question. Thank you so much for these questions. That's very helpful. What I would like to understand is, based on what you said, if I have an LLC, if I'm not generating 200K per year, I do not qualify to get accredited investor. Is that correct?
No, the accredited investor is your overall AGI, not regardless of the income that's coming from the LLC. The question I was
Correct.
asking about the LLC is if you put a bunch of people together, do they need to be accredited separately? But
Okay.
in order for you to be accredited, you're looking at your AGI, your adjusted gross income. You're not looking at the income that's generated from the LLC that you're going to be investing through. You got the you
Perfectly
got
said.
that?
Yes.
I was never
Correct.
rich enough to be an accredited LLC by income. I managed to be accredited only by the fact of the total assets, not counting my home. So.
Yep. It's either one. You qualify either net worth or income. It's either or.
Right.
Hmm.
Okay.
Thank
Well,
you.
I'm about a minute late, so I've got a 4:30, so I need to hop. But Ryan and I
Yeah.
talk consistently. He's probably a better resource for you at this point. But Ryan, I'll send you this deck if anyone wants a copy of it. We didn't get to a
Yeah.
lot of it, but if anyone's interested, please let me know. And hopefully we'll talk again soon. And if we can help with anything further, please give us a shout. I know it's getting late, but we still have some time.
Yep. Thanks, Fred, for hopping on. I appreciate it.
Thanks, guys.
All right, so if you want to hop off, that's fine. I'm going to go ahead and stop the recording now.